We help exchanges, cryptocurrency exchanges mainly, payment processors to scale fast, have cheaper transactions, and automate their wallet infrastructure. So I work as head of marketing, and I also work as the chief marketing officer for Blockdera. All right, so mastering your trading and investing psychology. I'll try and go over this as fast as I can. I would also make the slides available for those who might be interested in having it. So in trading, basically, there are actually several kinds of analysis you can do. There are actually several. These are not the three, but these are the three major ones that people would like to focus to. So in a broader sense, there's technical analysis, there's fundamental, there's sentimental. In crypto, there's also what you call on-chain analysis. Then there's psychological analysis. So there are lots of several analyses, but let's stick to these two. So technical analysis, a lot of people are familiar with that already. It has to do with looking at forming a trading strategy based on analysis of a price chart pattern. And the pattern on chart, or how a chart looks, is actually the collective behavior of the different market players, whether they are whales, they are trading robots, whatever they are. Their reaction on the chart or in the market is what we see on the charts. Now, after that, you have fundamental analysis. Now, this is based on socio-economic events. For example, the price of oil, is going up. Why? Russia is going to war with Ukraine, or rather, Russia has invaded Ukraine. And why is that significant? Because price of oil is now currently over $100. Why is it so? Russia is the second largest producer or exporter of oil in the world. So when there's a war, it means people are now hoarding oil. Why? Because they don't know for how long this crisis will go on and how much further it will escalate. Now that's one. Because of the war, lot of people are jittering because now there's economic sanctions placed on Russia that will not just affect Russia. In a way, it's going to affect the global economy too. So people are being careful of the positions they've opened in the different markets. And now that is also having an impact on the crypto market. So based on fundamental analysis too, you can say that the impact on the crypto market will be less because crypto is more resilient to this kind of economic events, and that soon when people are taking money out of stocks, taking money out of different places, eventually they want to put it into somewhere where they can have easy control, and that's crypto. So eventually that will push at least the major cryptos prices up if this crisis linger. So that's fundamental analysis for you. It affects the global economy in most times, and sometimes too, fundamental analysis might have to do with happenings in just a very small area of the economy. For example, if there's something happening within the Nigerian stock market, it will not really affect the American stock market. Why? Because it's on a smaller scale, and when you relate that to crypto too, a small coin having a major news will not like maybe let's say a small coin like Raka or MLT or any coin, let's say which other popular one, Blocktopia, or even CRO. If they're having a fundamental event, it might not actually affect the general crypto market. But when Bitcoin or Ethereum are going to have maybe a hard fork or a chain split or block halving, whatever, it's going to affect the entire market. Why? Because it's larger. The implications are bigger. Now, but our topic for today is psychological analysis. And what you will notice from number 1 and number 2 is that number 1 and 2 involves the actions and decisions and behaviors of other people. Psychological analysis, on the other hand, is analysis of one's mental state for an unbiased interpretation of 1 and 2. So for you to play well in the market, any strategy you've developed, your psychology needs to be right. If not, you'll be interpreting things wrongly, maybe out of fear or out of greed. And you won't be profitable if you do that. Now, psychological analysis. You see this little picture here? This is like the summary of psychological analysis. So you have to do with nervousness, overconfidence, fear, greed, anxiety, FOMO, doubt. Now you can see on the top that you have fear and greed. Now these are the two most important aspects of your trading psychology. And in the course of your investing and trading, you have to master these two. What makes you fearful? What makes you greedy? What are the triggers? How do you react? How has it affected you in the past? Now that the markets are going down, people are fearful. So is fear normal? How can I control it? How can I deal with it? How can I use it for my advantage? So those are the things that you now have to understand with your own trading psychology. Now, the thing with these other two is anyone can teach you technical analysis. Anyone can teach you fundamental analysis. But when you come to psychological analysis, no matter how long I teach you this, your own psychological analysis method will have to be built by you over a period of analyzing and understanding yourself. Because I'm different from you. I could lose maybe $1,000 in a trading or from out of a mistake and not really, be overwhelmed or paralyzed or be suicidal. There are some people that once they lose $500 or $300, they are thinking suicide. Now, trading psychology refers to the emotions and mental states that help to dictate success or failure in trading and investing. There are a lot of people who will give up on crypto investing or any kind of investing because of how messed up their psychology is. Now, this is what I want you to get out of here. And this is what we're having in this class. No matter how good you are with fundamental analysis, no matter how good you are with technical analysis, if your psychology is not right, if you've not mastered it, if you are still subject to the debilitating or the bad influences of fear and greed, you will still be very, very much messed up. You'll be very much messed up because you won't just be able to have control over what you do. So it's very important, imperative that you master your trading psychology. And I'm going to walk you through the steps. You have to remember that the most important thing in trading actually is your fear. The most important aspect of psychology is your fear. Fear overrides every other thing in your psychology or every other thing you know about trading, whether technical or fundamental. Fear is so powerful that it overrides everything. Now, listen to this, the 4 fears in trading. Now, 90% of the errors that you make in trading will be mental in nature. Now, these are how these fears can be categorized. So the 4 fears in trading, I actually came up with some of these terms. So I'm sure you're familiar with FOMO. So FOMO is the most popular one, fear of missing out. But I've crafted this other one, FOLO. FOLO is fear of losing money. Then there's FOMO, fear of being wrong. Then there's FELI, fear of leaving money in a trade. Now, how does FOMO work? You saw a coin, let's say $1. You're like, I beg, let's leave the coin. It rose to $2. That's 100%. You're like, let's leave the coin. It won't go anywhere. Before you know it, it has gone to $4. And everybody around you is just testifying how they've made money from that coin. then suddenly you feel FOMO, and somebody is shouting that coin is going to $20, meaning if something is at $4 and they are saying it's going to $20, that's still 5x. Then you suddenly forget that some people have already made 4x already, maybe within a week, and they are still shouting it's going to $20, then you jump. What has made you do that decision is that you have FOMO'd. You have allowed the fear of missing out to influence you into taking an action that you are unsure of or that you are not so comfortable taking. So because it's FOMO, you buy at $4, then unfortunately the coin goes to $3. Then others are done 4x, it's correctly to go back to $1. Because you're not confident, you have FOMO. So the things start dipping on you. So you're not paralyzed. Should I sell at a loss? Should I hold? Will it recover? Some people sell at a loss. They wait. It goes to $5. They buy again. It drops to $4. They sell at a loss again. Others will just hold it and maybe it goes to $1 and they are still holding. That's what FOMO can do. Then what is follow? The next powerful one is follow. Fear of losing money. Money is powerful because we work hard for money, maybe every day. You understand? I work every day. You know, even I work Mondays to Friday on the full-time job. But weekend too, I have side hustles, things I have to do. So I eventually work every day. You know, maybe apart from a few hours on Sundays. So after working hard and making that money, to see myself lose that money is painful. So there's that fear of losing money. So what does that fear do? You told yourself you buy a coin for long term, let's say CRO. Then you bought it at when it was like, let's say, how much is CRO now? Let's say $1. You told yourself I'm going to hold it for 2 years. Then suddenly CRO lost like 70% of its value. Then you're now thinking, what if it goes to zero? What if the coin rug pull? Now that's fear of losing money. Do you understand? Or you saw a coin at $1. Everybody's saying this coin is going to $3, it's going to $3. But you are thinking, I can't buy now. What if I buy and it starts going down? So that's fear of losing money that is stopping you from taking a decision. And of course, your mind will remind you of the times in the past where you bought a coin, but instead of it going up, it dipped and you lost money or you were rug pulled. You know, even till now, there are some coins, some meme coins that I can never buy. Doesn't matter who is telling me. What is FOMO? FOMO is fear of being wrong. You are afraid that you'll be wrong. And because you don't want to be wrong, you are not trusting yourself, so you don't take a trading decision. And it turns out to be a good decision. You know, so that's FOMO. Then fear of losing money in a trade. Because it has happened to me before that I bought a coin that maybe the coin moved from $1 to $5. I didn't sell because I was thinking it would go to $10. Then all of a sudden, that same coin, after some months, dropped to $2. It means I have left money on the table. And now I'm afraid that the new coin I buy will do that. So what do I do the next time? I sell off quickly. So that's fear. So all these fears, so long as you're a trader, will come, or an investor, will play out in your life in the course of your trading career. You know, so it's not left for you to know how to control and manage these fears, you know, so that you can have the best outcome. Okay, now 3 dimensions in trading. Okay, so I'm going to give you concepts now that would help you counter these fears. Now let's go into the 3 dimensions of trading. Now there are actually 3 main dimensions for a trader, but let me explain what they are. So the first dimension is the mechanical level. So in the mechanical level, you have learned a trading strategy. Maybe you've learned how to use moving averages as a technical trading strategy, or you've learned price action, how to use support and demand zones, or what some other people call key price reaction zones, or whatever name people give it. Or so you're trading support and resistance, you're trading moving averages, you're trading market structure. So any technical term that you come up with that you choose to trade, That is your mechanical trading strategy. And now, how is it mechanic? You have fixed rules. For example, if you're trading a mechanical strategy with moving averages, you could say, I will only sell, number one, if, number one, price must be at an area of resistance. That's one. Then number two, the moving averages, let's say you're using the 10 moving averages versus the 20 moving average. So you could say, I will only sell if the 10 moving average has crossed below the 20 moving average. That's criteria number two. Then criteria number three will be that I only sell if I see a particular candlestick pattern, maybe a bearish engulfing or a evening star or any candlestick pattern that you know that you put in your strategy. So you now have a mechanical checklist that you must follow. So now before you enter a trade, you now check, number one, is price at resistance? Number two, has my moving averages crossed? Number three, have I seen this candlestick pattern? So when you see them, then you're like, my conditions are met, time to take the trade. Now that is mechanical trading. Then the subjective strategy, or if you're using fundamental analysis, you find a way of doing it until this factor is present or that factor is present. That's when I make a trade decision or an investing decision. You know, for my investing now, there are only certain coins I buy. If I'm investing in an ICO, the vesting period must be at least 1 year. The team must be people who are known in the space. The key investors must be people who are known in the crypto industry. So that is my own fundamental mechanical checklist. Then the next level or dimension of trading is called the subjective. Now, in the subjective trading, you combine everything you know about trading. You combine all the strategies you've known. You know how to combine fundamental and technical and on-chain analysis and any kind of analysis. You know when to abandon your moving average strategy and trade only price action. Then sometimes you know how to forget about your candlesticks pattern and trade based on Heikin-Ashi, or you are just mixing everything and you're having a flow. So you don't actually have clear rules that you follow because your rules are too many, because they are based on many strategies, you know, that you have learned maybe over 5 years or 2 years or 3 years. Do you understand? So you are subjective. It means that it's not objective. You could change your mind. You are in a trade and you could change your mind and get out. You know, that's subjective. But in mechanical, once you enter a trade, only two things can happen. Is that I hit your stop loss or I hit your take profits. Then the final one is intuitive, or what I like to call spiritual trading. Now, this is the most advanced level of trading. In intuitive trading, you have become you are now having a mind of the market. You know, you can be sleeping and you feel that Bitcoin is going to go down. Like you are just, maybe you even have a dream that Bitcoin will sell. Then you go and close your trades. So it's as if the market is talking to you what it's going to do next. It's a very, very rare stage to get into. I advise every trader or an investor to focus on number one, be mechanical. Follow probabilities. Let it be rules, clear rules that you follow, so you know what works and what doesn't work. The only way this thing I'm about to teach you, this concept of trading, that will calm your mind and your psychology and make you profitable, is if you choose to adapt the mechanical style of trading or investing. Learning to think in probabilities. The market is a probabilistic environment, meaning you don't control what happens in the market. There's no guarantee that if you buy a coin at $1, that it will go to $2 or $5. There's no guarantee at all. We are only making predictions and guesses based on maybe things that have won or that have been profitable in the past. You know, and we're making those decisions that, oh, if that kind of a trade was successful, if that kind of, it's based on probabilities. So if it's based on probabilities, you cannot be acting as if you know 100% sure that something is going to happen. There's a guy I saw, he put all his money for children's school fees, money for house rent, he put everything and put it in a coin. He was so sure that that coin would do at least 5x. That coin lost 60% of its value on the day it was listed. Why? He was not thinking in probabilities. There are certain people that want to invest big money at once. I say, no, this money, break it down. Invest, let's say, $200. You want to invest $2,000. Invest $300 over a period of time. Get comfortable. Instead of you just putting all at once. And I always ask, is it your school fees? Is it your rent money? Why? Because if you're putting your rent money, then you're not thinking in probabilities. Because if you're thinking in probabilities, you think on both sides. What if it's a losing trade? What if it goes down instead of going up? What would I do? So learning to think in probabilities. To think in probabilities, you have to create a mental framework or mindset that is consistent with the underlying principles of a probabilistic environment. Now, a probabilistic mindset consists of 5 fundamental truths. These truths reinforce the fact that your fundamental analysis or technical analysis does not and can never control what the market will do. That can, no matter how you think I'm good with trading, that I tell you to buy a coin has no guarantee that the coin will do well. But no, so there's no guarantee. So you don't go putting in all your money into one trade as if you know exactly what the market will do. You don't. And this is the conclusion. You can never know for sure exactly how the market is going to move. For example, we are buying the dip now. We've been buying the dip. The dip can go on for another 1 year. Are you ready for that kind of outcome? Do you understand? Are you ready for that kind of outcome? If you're not ready, have some savings. You can't put all your money into crypto. What happens if the market goes on like maybe 2018 and keep being bearish or funny till are you prepared for that? If you're thinking in probabilities, you review every possible scenario and you prepare. Anything that happens, I'm okay. I'll be fine. That's the goal. Now, these are the 5 fundamental truths about the nature of trading. And I must give credit to, I have 2 trading psychology mentors. Number 1 is Mark Douglas of late memory. Then number 2 is Brett Sternberger. Okay, and now this is what he says, that to have the 5 fundamental truths about the nature of trading or investing, these are the principles. Number 1, anything can happen. You can buy a coin and it will do 10x. It's possible. You can also buy a coin and it will go down by 90%. Then the next one is, you don't need to know the 5 fundamental truths about the nature of investing or trading. Number 3 is, there's a random gains and losses for any given set of variables that define an edge. Now, what is an edge? An edge is any strategy that you use to gain or win or play in the market. So an edge or strategy is something you've tested over time to see that, okay, if I apply this strategy, out of 10 times, I'm going to win 6 times, or I'm going to win 7 times out of 10. So that's a good strategy. A very good strategy. So if you win 7, you lose 3, that's 70%. Man, you're a genius if you're 70% right all the time. Some of the biggest investors only need to be right 2 or 3 times out of 10. Paul Tudor Jones. Paul Tudor Jones, if he takes 100 trades, he only wants to win maybe like 10. Out of 100, he's only aiming to win 10 or 5. And he knows that those 10 will be monster wins. Monster wins. So you need to find a strategy that you're comfortable with, and you don't go judging other people's strategy or condemning it because you don't know what their plan is. All right, so let's go on. So number 4 says that an edge is nothing more than indicates a higher probability of one thing happening over another. So the strategy you're using only tells you that, okay, 70% of the time you will be right. But that 30% is a big 30%. The final one says, number 5, every moment in the market is unique. There are no 2 moments that are alike, no 2 trades are alike. If Bitcoin is at 40K and you're thinking, oh, the last time Bitcoin was at 40K, it bounced. So now that it's getting to 40K to bounce again, there's no guarantee that that will happen. Now one is, how do you build a trading mind? The first step is you must follow the 7 principles of consistency. Now, building a trading mind, you have to follow those principles of consistency. Two, to follow them, you need to have a check. What are your investment rules? What are your trading rules? You need to look at them. You need to be sure you're following them. The next one is you need to meditate. Meditation is for your mind what exercising is for your body. Meditation is powerful. So meditation helps to build your mind. It helps to put control over your mind. It's just the same way that as a human, you can't just go eating everything you feel like eating. You can't be eating every day or just eating anything you feel like eating. You need to put a control. So meditation too is like that. You can't be allowing every kind of thoughts to come to your mind. There are some you have to control. The thought of fear, for example, fear of losing out. No, I'm not afraid. If I miss this opportunity, there'll be others to come. It makes you a better person all round, like all round. You need to eliminate limiting beliefs. So we've come to the end of this class.
Thanks a lot, Ken Akure. Thanks to everyone for joining. This is the very first edition of the Mastermind Trading Bootcamp, but definitely not the last. We are going to have a lot of experiences together in the future. Thanks and welcome once again.